Management's president, Gary Kaltbaum, Bulltick Capital Markets chief strategist, Kathryn Rooney Vera, and the Bahnsen Group's David Bahnsen. Gary, let me start with you. Any surprises here? The market's just trading down a little bit lower initially.
I got one big surprise. I mean, last I looked, it's June 2020, and they're talking about keeping rates at 0 into 2022. For me, that's just utterly insane because there's so many variables, so many things that can happen. And one day the bond market may tell the Fed, hey, we're a lot stronger than you, and interest rates back up regardless of what they do. And then they're in a box. So I do not like the fact they're talking 2022, but everything else, no surprise. They're going to print money at $1.5 trillion a clip into the next year on top of anything else, any necessity, and away we go with more easy money.
Yeah, now stocks are gaining some traction. The S&P now, Kathryn, has turned positive, and maybe the Dow will be joining very shortly because $80 billion in treasuries a month, $40 billion in mortgage-backed securities a month. To Gary's point, they're not going to change their course for at least 2 years. And, you know, they talked about the impressive toolbox or being committed to the full range of tools. You got to believe they're going to also come up with some additional tools.
You got to believe it, Charles, especially if we're talking a bottom to top market rally above 40%. And the month of May, non-farm payrolls above 2.5 million jobs created. We are in a very good environment. And the Fed is talking about keeping the gas pedal to the metal. So we have to think, Charles, that asset purchases are going to go nothing but up from here. We are in a very good place as per the markets, yet the Fed is still keeping the gas pedal pressed firmly down.
Dow Jones Industrial Average off 300 points at the open. It was gaining a little bit of momentum into the announcement. It has joined the other two major indexes. Let's go back quickly to Edward Lawrence for more on this report. Edward.
Yeah, one point on inflation here. Going into this, a number of the Federal Reserve presidents, I talked with at least 4, who said they're willing to allow the economy to run hot in order to get the inflation rate back to their 2% target. Now, if you look at this, the Federal Reserve is indicating PCE inflation 0.8% this year, 1.6% next year, and 1.7% in 2022, still under their 2% target. So that could be into the thinking of the reason of keeping the federal funds rate near 0. We will know more when the minutes come out. Core PCE at 1%, 1.5% next year, and 1.7%. So again, this could be part of an indication the Federal Reserve is willing to let the economy run a little bit hot to get that inflation back up to their target. Back to you.
Edward, thank you very much. David Bahnsen, Run Hot. That could have been an AC/DC song. It certainly feels like we're doing some heavy metal stuff here, and the markets are reacting to this. What are your thoughts? Because there are a lot of people who believe the Fed made a mistake a long time ago. Maybe they've crossed the Rubicon and they can't turn back. They're gone down its accommodative path, and I don't know how they can get off of it without roiling the markets.
Well, they certainly cannot get off of it without roiling the markets. We learned that in the late part of 2018. But when Gary was saying that he wishes they weren't talking already about 2022, I agree that they shouldn't, but I certainly don't agree that I'm surprised that they're doing it, and I doubt Gary's surprised either. I just want to remind everybody, the financial crisis of 2008 was in 2008. They kept the zero bound until 2016, and they really didn't start raising meaningfully until 2017. It was almost a decade of 0%. They're being generous by saying 2 years. It's going to be longer than 2 years because once you've touched this thing, you can't disconnect from it.
To your point, going into the Great Recession, the Fed balance sheet was $800 billion, and by 2015, $4.5 trillion. Gary, you know, here's the thing. If we look at the 10-year yield, going all the way back for the last 50 years, it's always gone down since the early 80s, and that was Paul Volcker. He was the last Fed chairman to really follow his own beat, get off the script. But the script since then has been overwhelming accommodation. So they're just doing, to David Bahnsen's point, what they've always done.
But Charles, this is so much different. They've added trillions and trillions of dollars in liquidity, which is just absolutely distorting markets. And what you have to remember is we have seen them now buying up corporate bonds, buying up junk bonds. And what they've done is the savers get nothing, and then the savers have to pay up higher for bonds and get less of a yield because of them. My biggest worry is what I've been telling you for a while. They go in overboard, we end up with a climactic run in the market, which I think we may be having, and then we get the big, gigantic bust. They've been great throughout the years of creating booms and busts, and we saw one in 08, and now every time the market has dropped over the last 3 years, Powell has gone easier, and now he's done this with the excuse of the virus. But I'm sorry, there is no excuse for this. Markets are now addicted to them, and that's why they keep raising the ante. If they lowered it at this point in time, the market would drop 5,000 points, and that's not good news. We want markets to be free.
Well, Kathryn, if we're addicted to this, and you consider this a gateway drug, and you always need something else, the world is waiting now for that next something else. Now, the Fed's got a decision to make. Will they somehow try to cap yields, which they did, I think, back in World War II or something like that? Go negative. Powell said he doesn't want to go negative, but there was a research paper out from the St. Louis Fed that says that the only way he can achieve his goals is to go negative or to come up with something else more creative that we haven't even thought about. Which one do you think it's going to be?
It's not going to be negative rates, and I hope to God, honestly, Charles, that it doesn't turn out to be. Negative rates have proven nothing but adverse in their consequences. They're a massive tax and burden on the banking system. They don't work. This is artificial manipulation. The yield curve will be manipulated, and it has been. I expect we'll get an Operation Twist form of Fed operation, which basically means they buy up the short end, they let the long end run out, run off, and you get a yield curve steepening, which is exactly what has been already priced in. So yes, the Fed is going to keep Treasury rates at zero for the foreseeable future.
Of course, David Bahnsen, Operation Twist got its name from Chubby Checker's famous song and dance craze, because in 1961 was the first time the Fed got creative like this. And ever since then, the pressure has been on to find a way to get even more creative. We know at some point they're going to have to figure out a way to unwind this. But from an investor's point of view, do you think it's appropriate for the emergency that we're in right now?
Well, I think that we have to make a distinction between us talking on this panel about what we believe they ought to do and what we believe they're going to do, which is how we have to invest capital for our clients. See, Gary and I agree 100% on the side effects of what the Fed's doing. But I think that Kathryn's point about Operation Twist blended with yield curve control is what's going to happen. They're going to steepen the yield curve, and they're going to force the low end of the curve down when market forces want to push it a bit higher. But see, the issue that never gets talked about, and hasn't been talked about yet on the panel, is why all of this is the case. It's not just the Fed trying to coddle those of us in the stock market. This goes back way before Bernanke, by the way. It was Greenspan in '98 who was cutting rates when the economy was growing over 5%. This really is about excessive government spending. Eventually, the next tool to your question that the Fed's going to pull out is some better form of monetization, the Japanification of our economy, because we have too much government debt and its spending is not getting under control, and it's not going to get under control. That's the real issue here that dovetails with central bank policy.
And David, use the word control. When did we get to the point where one man in this universe, the most powerful man on the planet, has control of the biggest market in the world, our bond market? I'm not worried about the bond market now, but is there ever going to be a day where the bond market wakes up and fights back? That's my big worry going forward, the fact that he thinks he's so powerful to move every little thing around. The bond market used to be between investors and traders at a certain price and certain yield, and it's no longer. He controls the whole kit and caboodle.
Well, let me say something.
The bond vigilantes went the way of Charles Bronson. Let me bring Kathryn, before you chime in on that, one thing that David sparked made me think about, because when you listen to Jerome Powell, he talks about things that I have heard no other Fed chairman talk about, to a lesser degree, perhaps his predecessor, and that's Main Street. Like, if he feels like, and it's not official, but it sounds like he also wants to do more things for society. And whether that's backing up extraordinary government spending, it feels like Fed policy now is also, and particularly this week, after the last 2 weeks, I believe the Fed's going to be asked, Jay Powell's going to be asked in this Q&A session what the Fed's going to do to right the wrongs, because their work exacerbates income inequality. Their work exacerbates the wealth gap. I think he's going to do some things toward that as well.
I couldn't agree more. I couldn't agree more, and I think that we are in a very troublesome position when, you know, the general idea of consensus is that monetary policy is the panacea for all ills, Charles. And my concern here is that the rich are in fact getting richer, while the Main Street lending facility hasn't even been launched. In the meantime, you have an artificially juiced equity market by the Fed. You know, at some point, the Fed got their daily asset purchase up to 85 billion. We have something per day, you know. And so I think that this is going to cause the Gini coefficient, which measures income inequality, to just go, you know, through the roof. And I contend, and not to make it too political, but I do believe that we are going to see a unification of both sides of the aisle towards populism, because what we are effectively seeing is the big hand of Big Brother from the federal government and from the Federal Reserve, making the rich and those who have the resources to be in the stock market get richer, while we have many millions of people still unemployed.
So then let's get back to how this is informing your investments, David Bahnsen. You brought it up. Does this change your approach? Does it change the way our audience should approach their portfolio?
It absolutely does. And it's the biggest frustration I have with those of us who are critics of the Fed, who recognize the way they're distorting markets, the way they're punishing savers. I can say all those things just like Gary and Kathryn, it sounds like, mostly agree with me, and yet at the same time understand that I have to invest for my clients based on what is, not what I want to be. Right. And I believe very much that yield curve is going to be forced down, and we have to recognize the bid that creates for risk assets.
The burden of having to make rich people money is tough, my man. David, Gary, David, Gary, Kathryn, hold with me, folks, because I want to bring up something else here. Treasury Secretary Steven Mnuchin